Right, welcome back. I'm going to start this week's video with a little aside. One or two of you are not from the UK, and one or two of you have been asking what MoneyWeek actually is and what I do for a living there. So, very quick response. This is MoneyWeek magazine. It's the UK's best-selling financial magazine, and I'm the deputy editor. The MoneyWeek magazine comes alongside a fairly comprehensive online resource called moneyweek.com, and the reason I mention all that is that one or two of you have asked about the very topic that I was writing about on my strategy page last week. So with no more ado, I'm going to cover that topic now. Now the topic is all to do with valuing dividend-paying shares. So we're going to look at what is the quickest method of valuing a share that pays generous dividends. It's not easy. Just because it's fast doesn't mean it's easy, but it is a method that will spit out a number that's a nice starting point for those people asking the question, well, I want an income-paying share. I want a nice steady income. I want to be able to beat low interest rates at the bank. But how do I know whether I'm paying a low or high price for the share I'm looking at? And what I'm about to go through is one way of approaching the problem. It's called the Gordon growth model, named after the guy who came up with it several decades ago now, and it's been a kind of linchpin of valuing companies ever since. The formula I'm about to put up is deceptively simple. Basically, for those people who are not mathematicians, don't worry, this isn't a university course. I'm not going to go through the whole proof from scratch. I'm going to get straight into the heart of how you use it, and I'm going to use an example that I used in the magazine last week, Vodafone, just to see if we can tease out an answer to the question, at the current share price, is Vodafone a dividend-paying share after all? Nice, consistent dividend payer, cheap or expensive? And that's what we're trying to answer this week. Okay, so what is the dividend growth model? Well, it works on an assumption. It makes loads of assumptions, and some of you will be screaming at me as I make this video, you've made an assumption, you've made an assumption, you've made an assumption, and I will justify my assumptions, but that's the point. Valuing shares isn't easy. You have to make certain assumptions, and if you disagree with mine, I'm sure you'll be hitting the comment sheet fairly fast and furiously after you've watched this video, but that's fine, okay? Being able to think through the assumptions is part of the exercise. Right, so what is this model? Basically, it makes one big assumption for starters. It says, imagine for a moment I'm not trying to value a share, I'm trying to value a house, all right? What is a house worth? Well, eventually all houses fall down, all right? So the value of a house is the income it'll generate for you, which is called rent when it's a house, until it falls down. All right, almost in perpetuity. Not in perpetuity sounds like forever. I'm not saying forever because it will eventually fall down even if you repaint it and do the pointing and so on. But for a long period of time, I'd expect to get rental income on a property, and this model sets out from the position of saying that income is what you're after from an asset, and the value of all the income you can expect to receive in the future is what the asset's worth. So a very fast example, imagine I reckon I can get £10,000 a year from a house for 10 years before it falls down. All right, I've made some assumptions there already. Very, very simply, anyone who was using the model I'm about to describe would say, well, £10,000 every year for the next 10 years, ignoring the time value of money for a moment, which I cover in another video, would value the house at 10 years worth of rent of £10,000 or £100,000. Okay? If you thought you could get £12,000 a year for 10 years, £12,000 times 10 years is £120,000. That will be the value of the house now. Very, very, very simple model. Okay? Now, transpose that into what I'm about to use now to value a share or to value a company. Okay? And Professor Gordon came up with this model. And what he said was, number one, a company is the value of the dividend you expect to receive in the future. So now I'm valuing a company, not a house, and I'm not using rental income as the basis for valuing it, I'm using dividends, because that's the income you get from owning shares, okay? So if you can find a regular dividend-paying company and add up all its future dividends, you should get what you expect to pay for it now, all right? Because as an investor, that is the value of that share to you. Just as future rental income to some investors is the value of a property they buy today. Now, there's a problem. Several problems actually. Can you assume that your annual dividend is never going to change? No. Chances are the company will try and grow the dividend, okay? So maybe we need to build in something that reflects dividend growth in whatever this model is I'm going to apply in a moment, okay? And the third ingredient, so we've got two ingredients so far. We've got the idea of what is the company's level of dividends. So what's the next dividend we can expect to receive from the company? Because remember, valuing companies is all about looking forwards. We're going to build in some sort of assumption about the growth rate of those dividends to take account of the fact that the company's going to try and want to probably increase the dividend to at least give us some sort of inflation protection. And we're going to build in a third thing, which is if we buy a share, what is the minimum hurdle rate of return we expect to get as investors? Because after all, I don't have to buy a share. I could go and buy a house, all right? Or I could stick my money in the bank. So there's got to be somewhere in this model, you've got to build in the idea that I'm taking a risk by buying a share, maybe more of a risk than I would be by buying, say, a government bond. So that's got to be factored in too. So you've got at least three basic components, all right? And that is essentially how this model actually works. I'll put the formula up, and then because a lot of you out there want to know how to actually use it rather than sort of worry about the maths or leave that to the academics, we'll take a very quick example and see how we might actually work out the value of a company using this thing called the Gordon Growth Model. What it does is it says the model, which is a fancy name for a formula, says you can value a company by essentially taking the next dividend and dividing by the difference between that expected rate of return I mentioned just now and the speed you expect future dividends to grow at, which I'll call the dividend growth rate. Now, a mathematician will be thinking, put symbols on it, call this D1 and call that G, but let's not do that. All right, let's keep it in plain English. So the model says you value basically a share. All right, this is going to kick out the price, what the company is worth. Very simple model. Says you can do it by making certain assumptions and then plugging them in. And those assumptions are next dividend. Well, we probably have an idea what that is. We probably know roughly what that is for Vodafone. They've probably told us, okay? Our expected rate of return. That is very personal. That's quite subjective, and that's not easy, okay? At the end of this video, people will be throwing comments at me, I'm sure, saying, I don't agree with your assumptions. Well, I want you to do that, because I am going to make assumptions. That's the point. No one said this was an easy method, but it is a quick method. So we're going to come up with that number in a moment, and Vodafone's expected long-term dividend growth rate. What is that, okay? I mean, how fast, realistically, can a company grow dividends? Right, let's go to some numbers, okay? Now, at the point I'm making this video, okay, October 2012, Vodafone have made a forecast of the next dividend, all right, around about 12.6p. A little bit high for my liking because it factors in a special dividend, okay? So what I'm gonna do straight away, assumption number one, and this is my video, so these are my assumptions, challenge them if you will, but these are my assumptions, is actually, I'm gonna put in the next dividend for Vodafone at 10p, all right? They've said it's gonna be more like 12.6, but around 2p of that is a special one-off dividend, and we're looking for a consistent dividend stream, okay? Next thing I'm gonna tackle is the dividend growth rate. Now, again, some of you might be tempted to say, well, if we look back at the last 5 years of dividends Vodafone have paid, look at the growth rate in those dividends, surely we can just project that into the future. Well, no, you see, because if you do that, you get a suspiciously high number. And depending on which year you look at, you get a sudden jump. So for example, looking at the last 12 months, the next 12 months, you get a jump of like 30%. Now, we're honestly saying that Vodafone's going to grow its dividends at like 30% a year forever. I doubt it very much, because then the dividend would end up bigger than the UK economy eventually, okay? So we have to make a sensible assumption about the long-term, in perpetuity, rate of growth for Vodafone's dividends. And now, here, more assumptions coming up, but we could say, realistically, the dividend growth rate is probably going to be no more than the normal long-term rate of GDP growth for the UK economy as a whole, assumption number one. So I'm going to take the UK's long-term GDP growth rate of 2.5%, 2.5%, all right? And I'm going to add inflation. Now, how much inflation? Well, the UK has an inflation target of around 2%. It's the Bank of England's inflation target. So I'm going to add in another 2% for good measure. Now, if you're saying, well, he's just making this up, all right? Well, to an extent, I am, but, you know, at the end of the day, do you buy a share? Your decision, basically. So you've got to make assumptions. So what I'm doing here is I'm trying to come up with a long-term growth rate for Vodafone's dividends. This is not the rate they've actually been growing dividends recently, but I've suggested already that that is too high to be viewed as a long-term sustainable trend, right? So what have I got so far? The next dividend I know is 10p, or I'm going to say the underlying dividend is 10p. The long-term growth rate for those dividends, 4.5%. And now, if you think that's bad, wait for this bit, okay? Now I'm going to jump in and deal with this problem. What's my expected rate of return, okay? As a shareholder, what minimum level of return do I expect for taking the risk of investing in Vodafone when I could be putting my money in the bank or into a house, for example? Now, how am I going to derive that? There are a number of ways to do it. One is the capital asset pricing model, which I deal with in another video called Why the City's Share Pricing Model is Bust. All right? A lot of people will say, why is he not using CAPM? All right, well, CAPM is just as dodgy as the method I'm about to use, frankly. All right, but I'm going to use a slightly different approach just to get you thinking about it. So here's the approach I'm going to use. I'm going to say, can I find a long-term bond that Vodafone's issued? Okay, long-term, because this is a long-term exercise, valuing shares. Can I start there? Because a bondholder would expect to get less, because they're a bit more secure for investing in Vodafone than a shareholder. So I'm going to start there. All right, and there is a long-term Vodafone bond out there. The longest one that they've issued pretty much has a yield of 3.9%. Right, so I'll start there. Now, I want more than that as a shareholder. First of all, I want some inflation protection. All right, so as a shareholder, I might expect to add in a bit for inflation, and we'll call it the same inflation added in over here. So I'll put another 2% in CPI inflation, okay? Because I want that on top. But I want more than that. I want something. I don't just want what a bond investor can get, plus a bit of inflation protection. I want something on top of that that reflects the risk I'm taking by buying shares and not bonds, which are safer. Okay, and if you're not sure why, have a look at one or two of my other videos about bond basics. So what is that extra bit that I would want for buying shares instead of buying bonds? Well, it's a matter, to some extent, of personal preference. It's a matter of looking back at the past sort of behaviour of Vodafone shares versus bonds. At the end of the day, I'm going to write that in on this little speed introduction video as 3%. All right? So what I'm saying is that I would look at the return that a long-term bond investor is going to get out of Vodafone, 3.9%, add a bit for inflation, and add my personal equity risk premium on top of that. Okay. Now, there are other ways of doing this, all right? But then there are other ways of valuing companies. So basically, those people thinking, why hasn't he used straight CAPM? Okay, well, I can use to an extent what I like, as long as it's an expected hurdle rate that I'm comfortable with. So add that up, and you get 8.9%. Now, we're nearly there. So I've got the three ingredients that I was looking for at the beginning. I've got the next expected dividend, okay? That's the underlying long-term dividend. I've got an expected growth rate for dividends, and I've got an expected hurdle rate of return. All I do now is mash it all together, okay? Now, those of you out there with calculators, all you need to do is to divide 10p by the difference between 0.089 and 0.045, right? And if you do that carefully, all right, I'll assume you can do that out there. If you do that carefully, you should find it spits out a price of around 227p. All right. Now, let's not pretend that is a scientifically accurate number. What's important is, where is Vodafone now? Vodafone now is hovering more like around 170. Okay. So on that simple model, making my assumptions, expected price around 227, current price around 170. That would tend to suggest, using this very basic model, that Vodafone is a buy. All right, there's some upside in Vodafone. All right, now that's the way this model can be used. So let's finish the video. All right, there's food for thought there, especially about all the assumptions I've made. Let's finish the video saying when you shouldn't use it. I don't want you to rush out and think, great, any share I come across, any company, I'll just slap this on, throw out a number, and compare it to the current share price and see whether I should buy or not. Okay, what sorts of companies does this work best on? Number one, you want steady, long, well-established, dividend payers. This is not a method to apply to your whippersnapper penny share growth stocks. There are other things you can do there, but this is not one of them. This is for valuing nice, steady, blue chip, okay, dividend payers with a good dividend history, not companies that cut their dividends, not companies that don't pay dividends, not companies that vary their dividends. Okay, so there's caveat number one. Caveat number two, it really doesn't work well on fast growing companies. It's not that kind of method, okay? And the reason is, well, there's several reasons, but one of the problems you can get is this model falls over completely where this number is smaller than that number. All right, it goes negative. Then the model basically doesn't work, and that can happen in certain high growth sectors. All right, and if you're looking at a firm really that has either no earnings or no dividends, you're stuffed. Okay, it is after all a dividend-based growth model. All right, so there are some caveats. You can't just use it willy-nilly, but as I suggested in the title of the video, if you're looking for a reasonably fast way to get a handle on is this dividend-paying stock cheap or expensive, this, provided you don't mind making a few quite juicy assumptions, is not a bad place to start. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free. Just visit moneyweek.com.